So you're looking at the stock market. It's this world of incredible opportunity, right? But man, it is also just a ton of noise. You've got news headlines, social media going crazy, tips from your friends. It can be completely overwhelming. In all of that chaos, where do you even start? And that's really the big question, isn't it? I mean, you see all those ticker symbols flashing by, you hear about the big name companies, but when it's your own hard-earned money on the line, how do you figure out which company is actually worth investing in? How do you cut through the hype and find something real? Well, let's dive into that. The answer, as it turns out, is surprisingly simple. Now, that doesn't mean it's easy. It's not about finding some secret formula or getting a can't-miss hot tip. Nope. It's all about just putting in the work to actually understand what you're buying. Okay, so what does doing your homework really mean when we're talking about investing? It all kicks off with one really powerful shift in how you look at the whole thing. This right here, this is a total game changer. When you buy a single share of stock, you're not just buying a little blip on a computer screen. You are literally buying a small piece of an entire business. I mean, think about it. Would you go out and buy that coffee shop on the corner without even looking at its books, without understanding how it makes money? Of course not. So why would this be any different? All right, so if we're going to think like business owners, then we have to know how the business is actually doing. And that means we've got to take a little peek at its financial report card. And trust me, it's way simpler than you might think to get the basics down. You really don't need an accounting degree for this part. It all boils down to four pretty simple questions. First, how much money is coming in the door? That's your income. Second, how much money are they spending to make that happen? Those are the expenses. Third, what's actually left over at the end of the day? That's the profit, the lifeblood of any company. And finally, and this one is huge, how much money does it owe other people? Because way too much debt can sink even a really profitable company. Another handy little tool you can put in your toolkit is the P/E ratio. That stands for price to earnings. All it does is compare the company's stock price to how much profit it makes for each share. So let's say a stock is $20 and it earns $1 per share, its PE is 20. Now, a really high PE could mean investors are expecting massive growth. A low PE might mean it's being overlooked, or maybe that the market sees some problems ahead. It's just a quick snapshot of what people are expecting. Now, let's talk about a classic mistake that a lot of beginners make. You know, when we're hunting for a good deal, our eyes just naturally go to stocks with a low price tag. $1 a share, $5 a share. It feels like a total bargain, right? But this can be a massive, massive trap. Look, we all love a good sale. We're conditioned to look for that discount. But in the stock market, a sale price can sometimes be a really serious red flag. A low price does not automatically mean that something is a good deal. A lot of the time, it actually means something is deeply wrong. And this right here is the critical difference you've got to understand. A cheap stock is all about the price tag. A good stock is about its actual value, the health of the business and its potential for the future. Your homework is the very thing that lets you tell the difference. See, the real goal isn't just to find something cheap. It's to find a great company that's being sold at a fair price. So why on earth would a stock be so cheap in the first place? Well, the price is low because people are selling it, and they might be selling for some very good reasons. They might see some fundamental problems with the business that you don't. And in a worst-case scenario, the company itself could be in serious financial trouble, maybe even heading for bankruptcy. Now, that's a bargain that could end up costing you everything. Okay, so we get it. Researching individual companies is super important for avoiding those traps. But you might be thinking, what about just buying a mutual fund? One of those big baskets with lots of stocks in it. Does the whole homework rules still apply there? Well, as our source material points out, there's a trade-off. When you buy a fund, you get the whole basket. You get the good stocks, the bad stocks, and probably some overvalued stocks too. You're diversified, which is good, but you're also buying whatever's in that fund, no questions asked. But if you do your homework on individual companies, you give yourself a real shot at finding those undervalued gems that the rest of the market might have totally overlooked. And that, my friends, is the whole point. That's the payoff for all this work. The goal is to understand a company so well that you can confidently spot a solid business that, for whatever reason, the market just hasn't fully appreciated yet. That is the art of smart investing. Which brings us to the final, and honestly, the most crucial part of this entire process. Because after you've done the research, crunched the numbers, and done your analysis, it all comes down to one person who has to make the final call. This is what it's all about. It's about true empowerment. This isn't about blindly following some expert on TV or a random tip you saw online. It's about you building the knowledge and the confidence to stand by your own decisions. You did the work, you understand the business, you make the call. So we'll leave you with this challenge. Instead of just wondering about the market, go pick one company, any company that you're genuinely curious about. What's the very first question you're going to ask about it? What's the first piece of homework you're going to do to decide for yourself if it's a hidden gem or just another trap? The path to becoming a smarter investor starts right there.